We have a huge earnings week coming up, and there's one day in particular that can make or break the market. Wednesday, April 29th, we have six gigantic, very important companies reporting their earnings. We have Google, Microsoft, Amazon, Meta, Qualcomm, and Automatic Data Processing. These are six very important companies to the overall stock market, and these are six very important companies to Interflame Finance portfolios. So today we're going to take a look at these six different companies. We're going to, as always, look at their safety metrics, their Interflame Finance safety scores, and their past performance. Then we're going to take a look at their growth metrics and those Interflame Finance scores. We're going to look at intrinsic values. Those are what the companies should be trading at. And then finally, we'll look at how we might invest $1,000 into these six companies. So we're just going to get right into it and look at ADP, Automatic Data Processing. They have one of the best PE ratios of all of these companies at a 19. Price to sales looking pretty good at 3.7. Their free cash flow yield at 5.8%. We usually like that to be 7% or higher, but with high growth companies like these, we don't expect that all the time. Dividend yield, 3.4%. This is a dividend king, 51 consecutive years of increasing their dividend payments. We like to see that. Payout ratio getting a little high, but their beta at 0.8 gives us a little bit of safety in our portfolio. So ADP did not have the best past week, down about 2%. Over the past month, they're down about 6.3%. In 3 months' time, they have lost about a quarter of their market cap, so that's not good. Past 6 months, they've lost about a third, but down 30%. Over the past year, that is down more than a third at 33.05%. So this is a company that keeps going down and down and down. Is a bottom consolidating? Are we starting to see maybe there's some recovery in the stock? Our intrinsic values will tell the story then. Now, we've talked about Amazon in the past. They are trading at a slight discount. Their historical PE ratio over the past 5 years has been a 44. Now they are down to about a 37. So a little bit of a bargain here. Debt to equity looking solid at 0.4. And their beta is higher than 1. It's at a 1.4. So there's a lot of volatility in this particular stock. Now, in contrast to ADP, Amazon has had a better week, up 5.4% in that time. Over the past month, up 25% plus. That's very nice to see. As holders of Amazon, we are very happy to see that. Over the past 3 months, there's been a dip and they've recovered. They've grown about 10.38% in the past quarter. In the past half a year, they're up almost 20%. And over the past year, Amazon is up 46%. Now, Google is trading rich. Their historical PE is 24.4, and they're now trading at a 32. So kind of going in the opposite direction. This is trading rich. We'll see if the intrinsic value hints that there's some sort of margin of safety to this company. But their interest coverage is phenomenal at 175. Debt to equity looking very solid at 0.2. Payout ratio, 7.73%. This is a relatively new dividend payer. Their dividend yield is just a 0.2%. So you're not buying Google for any sort of dividend, any sort of sustainable income, but they have grown their dividends for 2 consecutive years. Return on assets, a phenomenal 20.4%, and their beta just over 1 at 1.1. Google up just a little tiny bit in this past week. Over the past month, they are up a lot, actually, 14.02%. In this past quarter, they're up about 5%. In the past half of the year, Google has really done a great job in its performance, up 36%. And over the past year, more than doubled your investment, up 122%. Meta is also trading pretty rich. Historical 5-year PE ratio at 23. They're currently trading almost 29. They do have a pretty decent payout ratio at just 9%. So their 2 years of dividend growth can probably continue. But just like Google, not something that you're buying to get a lot of income, just a 0.3% dividend yield. Their free cash flow yield a little bit better than Google's at 2.7%, but their interest coverage just at 71.5. Now that is the second best number of all these companies. Finally, we'll note that their return on assets is also the second best at 17.5. Now Meta was up and down last week, down about 2% overall. Over the past month, Meta has grown almost 12%. In the past quarter, Meta is up just 2.5%. And in the past year, Meta has gained about 30% more in its market cap. Microsoft has the second largest market cap of these 6 companies. Their PE ratio is a 26.6, and that is a discount from where they've historically traded at 34. Their debt to equity looking very nice at just 0.3. They are a 20-year dividend increaser, so they are almost at that dividend aristocrat status. Their dividend yield is just a 0.8%, so slightly less than 1. Their beta at 1.1, so close to 1, not as much volatility as some of these other companies. Microsoft is pretty much flat over the past week. This past month, it's actually up 11%. Over the past quarter, Microsoft is actually down 8.87%. In the past half of the year, Microsoft has lost 18% of its value. And over the past year, I mean, a lot of ups and downs for this company, up only 13%, which is, what you basically would expect in a year from the market, maybe a little bit more. But this is Microsoft. This is one of the big dogs, and we would expect outperformance from the market on such a fantastic year that we've had. And finally, we have Qualcomm. Now, Qualcomm we featured in the last video that I will put in a card at this point right here. Historical PE ratio 19.4, and they are trading at more than 30. So that's not looking good. That is trading quite rich. But they do have the best free cash flow yield at 8.1%. This is a 23-year dividend grower, and so their dividend yield at 2.4% is the second best of all these, and they are almost at that dividend aristocrat status. Their return on assets is just okay at 12%, but that payout ratio is sneaking up there, and so hopefully they can maintain not just their dividends, but keep growing their dividends in the years to come. I'm sure they want to get that dividend aristocrat status. Now we see a huge jump in Qualcomm. Last week on Friday, it jumped 9%. Over the past month, we're up 16%, due in large part to that big jump on Friday. Over the past quarter, Qualcomm is actually down about 4.5%. Over the past half of the year, Qualcomm is down about 12.5%. Now, we do see that perhaps this bottom has formed and that Qualcomm is due for a recovery. We see that their all-time highs came in at just about 188. So if they can reach those levels again, it's going to be a lot of nice upside to this company. So now what we do is we score these companies from minus to positive 10, negative 10 being the most absolutely horrible company and positive 10 being the best run company in the world. 0 is neutral, but we like to aim for 5 and higher, and we see that the lowest scoring company is Google, due in large part to their very rich valuations, trading at a 32 compared to their 24 historical. But we see that even Google is scoring above that 5 mark. That's very nice to see. Amazon coming in at a 6.2. If you follow this channel, you know that Amazon has really struggled to get above that 5 mark, but as far as safety, Amazon is finally cracking that and getting to be a 6.2. Automatic data processing coming in next at a 6.4. Meta coming in at a 6.6. Qualcomm takes second place at 7.9. And at the top of the leaderboard for safety is Microsoft. So before we continue, if you're getting anything out of this video so far, please consider liking it. That really helps out the channel. And please consider subscribing so you never miss a video, so you can always come back for more safety metrics, growth metrics, and intrinsic values. So as far as growth goes, ADP is first. We have a forward PE, very nice at 16.7, and a 5-year forward PE at 12.6. So that means that at today's prices, based on their projected growth, top line 5.8%, bottom line 8.4%, that this company will be trading at a 12.6 based on today's valuation metrics and today's prices. Now, that looks pretty good. Their return on equity is 74%, some of the best of these 6 companies. Return on invested capital, 45%. Pretty healthy profit margins at 20%. But these single-digit bottom and top line growth estimates are a little concerning to us, especially when you look at their PEG ratio. Yes, we do like 2 and under, but for growth companies and tech companies, we really want that to be under 1. Now, nothing really stands out for Amazon. We have a PEG ratio slightly lower at 1.6, debt to equity lower than ADP at 0.4, return on equity and invested capital looking okay, but not some of the best numbers, profit margins looking just under 11%. But we do have top and bottom line growth between 11 and 15%. Very low free cash flow yield again, but their 5-year forward PE coming at an 18. That's pretty good for such a large behemoth of a company like Amazon. Now, Google does have some pretty nice growth metrics. They have very low debt to equity at 0.2, return on equity and invested capital in the low 30s to mid 30s, profit margins very healthy at 33%. We do see the PEG, the highest of these 3 companies so far at 1.9, almost at that 2 mark. Forward PE at 27.4, with their 5-year forward PE coming just under Amazon's at 17.1. Meta's up next with a PEG exactly at 1. That's very nice to see. We see top and bottom line growth in the mid-teens to maybe even low 20s. Their 5-year forward PE is an astonishing 11.8. That's very, very low for this high growth company. Forward PE coming in at 21. They also have very low debt to equity at 0.4. Now, one thing about all these companies that we should say is that one concern on Wall Street is that their CapEx spending is a little out of control, that they are investing way too much into their AI infrastructure and their AI build out. So we'll see if that's an investment that pays off. It might take a couple years for that to be really clear in the overall story of these companies. But when you look at these return on equity and invested capital numbers in the mid 20s to low 30s, Meta is looking pretty solid. Profit margins at 30%. Microsoft also coming in with some pretty decent numbers, very similar to Meta's. They have a PEG ratio slightly above 1 at 1.4, forward PE at 23.3, and their 5-year forward PE at a 12.5. And that's if they can execute on 16.4 EPS growth every year for the next 5 years, and their top line expected to grow about 13%. Profit margins, the healthiest of all these companies at a 39% even. And finally, Qualcomm, also a mixed bag. They have the best free cash flow yield at 8.1%. We like to see that above 7%. Their forward PE, a very nice 13.9. It's the lowest of all these companies, but that forward PE does tend to sneak up after 5 years, back up to a 16.2. So kind of going in the wrong direction there. And we see, speaking of wrong directions, the PEG ratio at a very high 3.4. So also scoring these companies from -10 to +10, with -10 being the worst, +10 being the best, and 0 being neutral. We see that Amazon is once again coming in under that 5 mark. If you follow this channel, you know that Amazon is always just barely at that 5 or higher mark. So Amazon coming in at a 4 for the lowest growth score. Google coming in at a 4.8, also just slightly under that 5 mark. Qualcomm, the first company, over 5 at 5.8. ADP has a growth score of 6, and a 6.5 goes to Meta. And the top of the leaderboard is Microsoft, once again at a 7 for growth. So now we're going to do some analysis and see if these are worthy companies to invest in the Interflame Finance portfolio before they report earnings on April 29th, which is Wednesday. So what we're going to do is we're going to look at their growth scores and their safety scores. We're going to average them, but not just a normal average. We're going to put slight emphasis on growth. So growth is going to get a weight of 7 for all these companies. Their safety scores is going to get a weight of 3. And that brings the average score of Amazon to a 4.7, just missing that 5 mark. Their intrinsic value is $214. They are currently trading for $264. And so that gives us a 23% premium on Amazon. So we think Amazon should be trading for $214, and that is one of the lower estimates among Wall Street analysts. So Wall Street thinks that this company should be trading for, on average, about $284. The high estimate coming in at $325, the low estimate coming in at $175. That gives us an average growth of about 7 to 11% over the next year, according to Wall Street analysts. But the bears out there say that Amazon should be trading for $175. That would be about a 34% drop in the stock price. The overall consensus on Wall Street, however, is that Amazon is a strong buy. Next up is Google with an average score of exactly 5. They are currently trading for $344, but we think that they are only worth about $256. So that would imply a 35% margin of safety, or in other words, a 35% premium that you'd be paying for Google right now. Now, what do we mean by intrinsic value? Well, that's what the company should be trading for based on their growth metrics, based on expectations, and based on their PE ratios. And so what you see here are the different intrinsic value calculations that we have for Google. We have the PE ratios model. We have the dividend discount model, the discounted cash flow, and Graham's valuation. And these are actually models that you can build out in Google Sheets yourselves. So go down to the description of this video and you will find 4 different links to these 4 different intrinsic value calculators. You'll notice that we are not doing the dividend discount model, mainly because Google is not a strong and reliable dividend payer, but we do compute the other 3. We average them and we get what's called the intrinsic value of this company. You can go ahead and do that for Google or any other company that you want to value to make sure that you're getting a good deal in the market. So an absolutely essential tool for any investor to have in their toolbox. Go down to the description of this video, make sure that you build out your own intrinsic value calculators so that you can also be an informed investor. Now, ADP coming in with an average score of 6.1. Their margin of safety is only 6%, but it's at least positive. They're currently trading for 197, and we think that they should be trading for 210. Now, our estimate of 256 for Google is quite low. However, there are lower analysts out there saying that it should be trading for 190. That would be about a 45% drop in the stock price. The average consensus is that people are saying that Google is probably trading for around fair value, only with about 4 to 9% increase over the next 12 months. However, there is a higher analyst or two saying that this is a company that should be trading for 420. That's about a 22% increase in the stock price. However, the overall consensus is that Google is a strong buy. ADP coming in with an average score of 6.1 with a razor thin margin of safety. However, it is positive at 6%. They're currently trading for 197. We think at Interflame Finance that ADP should be trading for 210. And that 210 is actually the low estimate that Wall Street has. That would be about a 7% increase in the stock price. The overall consensus on average is that this is about a $275 stock. That would be about a 40% increase in the stock price over the next year, with the highest analyst coming in with a price target of 340. That would be a 73% increase in the stock price. Now, despite all that bullishness and despite those great numbers, we see that the overall consensus on Wall Street is that ADP is a hold. Qualcomm with a slightly higher score of 6.4 and a very nice margin of safety of 26%. They're currently trading for 149, and we think that they should be trading for 201. And 201 is one of the higher estimates among Wall Street analysts. On average, they think that this is basically trading for fair value. The average consensus coming in at 160, low estimate coming in at $100 per share, high estimate coming in at 216. Overall consensus on Wall Street is that Qualcomm is just over the buy mark, almost a hold. Meta has a slightly higher average score of 6.5 with a margin of safety of 10%. The current stock price is 675, but we think that Meta should be trading for 749, and 749 is actually low and rather bearish compared to Wall Street expectations. Wall Street expectations think that this company is going to grow to about 825 to 838. That would be between a 22 and 24% increase in the stock price. The high estimate coming in at over $1,000, that would be a 50% increase in Meta stock price. And even the low estimate saying that this is a $700 stock, that would imply about a 3.7% increase in the stock price. And probably, given those numbers, no surprise that Meta overall, the consensus is that it is a strong buy. And finally, Microsoft has an average score of 7.3, and they're almost trading for fair value. The current stock price is 425, and we think the intrinsic value should be 444. That is quite low when you compare it to average analyst expectations at 538. The average consensus on Wall Street is that Microsoft is going to grow between 37 and 41%. High estimate coming in at about a 59% growth. That would be a 675 price target. Overall consensus for Microsoft, really no big surprise. It's such a great company. Overall consensus is that it is a strong buy. So this would be a great place to remind you that nothing that we say on this channel is financial advice. We are not telling you to buy, hold, or sell anything in your portfolio. This video is for educational and entertainment purposes only. Always do your own research and your own due diligence before putting your hard money into any company at all. What we at Interflame Finance do is we look at their average scores, we look at these companies' margins of safety, and we figure out how should we invest our capital. So what if we wanted to invest a hypothetical $1,000 into these 6 different companies? How would we do that? Well, probably no surprise that we would not put anything into Amazon. It is trading for a 23% premium based on our expectations, and the average score is below 5, coming in at 4.7. If we want a 15% discount in the stock price, we would buy it at 182 or lower. If we wanted a 35% discount in the stock price based on our intrinsic value of 214, we would buy Amazon at 139 and lower. The same goes for Google. We're not interested in this company. They're trading at even more of a premium, even though they have slightly higher score coming in at exactly 5. We would consider buying Google at 218 or lower if we wanted that 15% discount, and Interflame Finance portfolios might consider buying heavy if it was 166 or lower. ADP would get about 13% of our capital, or $131. Now, they are not at that buy mark. They're not at that 15% discount or 179 or lower. They are trading for 197, and they are certainly far away from that buy heavy mark at 137. But given their razor thin margin of safety and given their average score at 6.1, it's something that we might nibble at. Now, Qualcomm is coming in at a buy with that 15% discount or greater at 171 or lower. It's currently trading for 149, and it's almost at that 131 price target. That would be the buy heavy. Given the small margins of safety in these other companies, and given the fact that these scores aren't too fantastic, they're not in the 8s or the 9s, we would actually put about 55% of our capital, or $551, into Qualcomm. Meta would get about 21.3%. They are not a buy or a buy heavy with that 15% discount or greater. They do have a 10% margin of safety. We would consider buying this for sure at 637, and we would buy much more heavily if it was at 487 or lower. That would give us that 35% discount. And finally, we would put about 10.6% or $106 into Microsoft, mainly due to the fact that it is trading so close to its fair value at just a 4% margin of safety. That is razor thin. We would buy Microsoft for sure at 377 or lower, and we would buy much more heavily at 289 or lower to get that 35% discount. So there you have it, folks. These 6 companies and others are reporting on Wednesday, the 29th. It's going to be a wild day in the stock market. Weakness in any of these companies could send the stock market tumbling, and strength in these companies could send the stock market to all-time highs once again. So let us know in the comments below what you think about these 6 companies. What are you buying? What are you holding? What companies are you most looking forward to on this earnings season? Remember, if you got anything out of this video, please consider liking. That would really help out the channel, and consider subscribing to the channel so you never miss a video. You never miss on any growth, safety, scores, average scores, or intrinsic values for your favorite companies. We appreciate you being here. We appreciate your support. We are continuing to grow out the channel. We are very excited to serve you. Thanks for watching the video, and we'll see you in the next one.